So hello and welcome to another one-to-one online event. Today I'm here with Julian Babarczy, Chief Investment Officer at Jigsaw Investment. So Julian, thanks for joining me today.
Hey Amy, thanks for having me on.
And so today we're just going to, talk about some investment themes and, what you're currently focusing on. So to begin, what are some of the current trends that you're seeing across the battery metals markets in terms of supply, demand, and pricing?
Yeah, Amy, well, I guess the battery metals are a subdivision, I guess, of the broader commodity markets. And so in many respects, they have some of the similar drivers that we're seeing there. And overall, at a really high level, we're seeing a slowdown in many of the key economies. We're seeing some concerns in the China property market, which is also spilling over to a slightly slower economy up there as well. So the backdrop at the moment for commodities in general is a bit negative, and that's flowing through to the battery minerals and battery metal space. While, I think we're definitely in a secular bull trend because of the huge growth in demand for some of these commodities. You can't fight the tide at all times, and we're seeing a general softening in a lot of the commodity prices that we're tracking in this battery metal space. So that's everything from lithium, which we've seen fall quite significantly, had a small rally earlier this year, but it's resumed a somewhat small downtrend in recent months, and that's providing headwinds. We've had a similar dynamic happening in the graphite markets as well. So I think in the short term, it's quite a negative tilt to the sector. But I think, as I said, overall, I think we're in a secular bull market, but a cyclical bear market. So I think what we're seeing in the battery metal space is similar to what we've seen quite a lot over the last probably 5 or so years. A lot of underlying demand. You've got some very small commodity markets that can get swayed from time to time by a little too much or not enough supply. And at the moment, we're having a small mini supply response in some of these commodities, and that's just overwhelming the short-term pricing. So we're seeing a reduction in pricing, which is really flowing through to a lot of the investments we're looking at, which are generally getting cheaper by the day, not more expensive. So depending on your outlook for, I guess, the next number of years, it's either a buying opportunity in some of these commodities, or it's a situation where they're just returning to a more normal sluggish. We're definitely on the more bullish side. As I said, we think it's a secular bull market. And so what we're seeing now is creating some pretty interesting opportunities in the market.
Yeah, interesting. I mean, we've seen quite a bit of growth in terms of the importance of some of these key kind of battery metals, with the rise of the green energy transition. And this is definitely impacting supply and demand, but also just kind of, there's a lot of analysts have been predicting some pretty significant shortages in a lot of these battery metals for the coming years. Do you see this as being as big of a shortage as predicted? What's needed right now to kind of ensure that the energy transition can happen and that we have the right supply of these key metals?
Yeah, well, look, I think from my point of view, it's quite hard to argue that we're not going to see some shortages emerge in some of these critical minerals and battery minerals over the next decade. Again, we're talking about pretty small markets, ones that haven't had huge demand prior to the energy transition. And so you've had a situation where you've had to bring in a lot of new mines. We've seen a decent supply response over the last 5 years, which is natural. But I would argue that the easiest and highest quality projects have been brought on stream. So what we need to come on stream will be the ones with the higher cost curve, the ones with higher capital, typically lower grades, typically higher costs overall. And so I think the outlook is pretty supportive for a lot of these commodities. Again, as we spoke about earlier, we've seen some short-term weakness in some, but I think that's a transient factor. I think what we will see is the underlying demand continue to grind higher. And I think you'll see sporadic appearance of supply onto the market, but as a general rule, it's probably going to be undersupplied. And I think we're going to see, pretty strong growth in some of these commodities, which should make an attractive investment landscape. So, overall, I think it's pretty interesting. And yeah, I think there's some specific commodities like graphite and others where the expectation is that there'll be pretty gross undersupply. That may be tempered somewhat with the other potential substitution factors. Natural graphite can clearly be substituted with synthetic graphite. But I think overall, you're going to see a generally growing market, and all these commodities will, I think, as you look out 5 and 10 years, the law of large numbers suggests you just need all the mines that are slated for production to come into production to continue to feed the beast that is the electric vehicle and energy transition regime that really is powering a lot of these super cycles.
Yeah, absolutely. And so as an investor that's looking into, getting more into this space, what are some of the criteria that you yourself use to evaluate companies? Are there growing opportunities in Australia specifically? This is going to be in the ASX edition. So we're also kind of looking at the growth of the junior space within Australia.
Well, look, I guess at a very high level, the first step normally with commodity markets is to have a view on the macro environment, and that really is a view on the commodity. So I think you've got to be favourably disposed to the battery metal space and think that the prices are probably going to be higher in the future to have interest in buying the underlying stocks. So you take it as a given that the most readers will form their own view on that. Again, there's conflicting news out there, so I think you need to do your work and wade through a lot of the noise to form your view. But in a very simplistic level, a lot of these commodity markets need to grow not just by 10 or 20 or 30%, but by multiple fold over the next decade to feed what is the expected demand profile. So for me, it's hard to see that the commodity prices aren't going to go up over time. And also to incentivize the supply that you need rising prices. If you don't get the rising prices, the mines won't get developed and you'll lead to a greater shortage down the track. So I'm pretty comfortable that we'll see rising prices generally over time with many cycles on the way through. And then the next thing you got to do is step down and look at the companies you're investing in. So then you're really into the fundamental investment analysis realm. And there you're looking at a range of different factors. My experience, these sort of companies at the smaller end who are developing projects, it's very important to have good people running them, people you trust and people who often are very much aligned with shareholders. So you'd hope that some of the managers have good equity positions in the company so that they understand as the companies need to raise money over time that there's dilution that goes with that, and so they're timing the capital raises correctly. But beyond the people, it's then just the fundamentals of the project. So you're looking at the grade of the project. Obviously, grade is king in every commodity because that generally leads to much lower costs of production, which means greater returns for shareholders. You're looking at the resource size and scale. Again, investors prefer large-scale projects, even though it's not always necessary to have having a 100-year mine life isn't that relevant inside most DCF analysis. Often it's the first 10 or 15 years, which generates all the value in the short term. But you still need a scale of resource that is compelling for investors to get behind. Then you've got more technical aspects, things like metallurgy, and that's something that's often overlooked by newish investors to the market. But it is very important to understand how the resource actually beneficiates up and whether you can liberate all the impurities so you can get a very high quality product at the end of the day to sell. And that's the one thing which is different for a lot of these battery minerals is that the end product is crucial. The specifications of the end product is key. What it is in the ground is a good lead indicator, but it doesn't mean that it's going to be high quality once you get to the end result. And the purity levels required, being that you need very, very low impurities, means that the metallurgy must be such that you can liberate all the impurities. If you can't do that, then the resource may end up being worthless because it's not of a quality that can actually be turned into an economic mine. So then you've got to run, obviously, your analysis on your costs and your revenue expectations and derive a valuation of the company. But it doesn't stop there because, as we all know, these small companies will go through periods of euphoria and periods of bearishness. So you've also got to read the sentiment in the market as well. But obviously it starts with the macro and then it drills down into the micro when you look at the individual stocks and the individual companies and mines that make up those. And then you've got to make your assessment on obviously whether there's some catalyst to keep investors interested as well, because the market doesn't just buy good long-term stories. It wants news flow. It wants to understand how companies are progressing. And so, there's a whole range of factors that need to be taken into advantage. And it's not an easy task to keep on top of all those factors. Even for a professional investor like myself, you could spend 24 hours a day analyzing these things and still you miss sometimes quite obvious things. And so just would encourage people to be very diligent when they're looking at the individual companies that they're analysing and looking to invest in.
Yeah, no, absolutely. I want to, just following on from that, maybe we can talk a little bit about some of the bigger challenges and risks facing these markets. So the battery metals markets at the moment. So what do you see as kind of the biggest, as I said, challenges, risks, hurdles for the market?
Yeah, one of the key risks, I think, for battery minerals in particular is because they're niche commodities, they're not really well understood by a broad section of the investment community. So often the time that's required for investors, particularly larger institutional ones who need to put more money to work, the time that's needed for them to get their head around the idiosyncrasies of an individual battery minerals market like lithium or maybe graphite or high purity alumina or others, it's a very big task. And so one of the big issues facing these companies is that they're just not very well understood. They're not very well researched. And as a result, it's much more difficult for large investors to get the conviction that's required to back these companies. And that means that often the investable universe of people looking at these companies is quite slim. And that means that it can be hard to raise significant amounts of money. So I guess there's an educational process that's required by a lot of these companies to educate the market about the operating environment they are actually operating within. But once you can educate enough people, like lithium that's gone mainstream, I think people see that it's a market that is investable now, and you're seeing very big institutional investors get behind some of these very large producers. And that's a very good sign, and that filters down. But the next step is funding. So a key risk is always for these companies to be able to access enough money when they need it, not only to continue to expand the resource and do all the relevant studies that are required and undertake the relevant metallurgical work. And that can take many years to drill out a project and properly understand it, go through pre-feasibility study, through to definitive feasibility study, and then you've got to fund the project itself. And one of the big risks for this sector is because there's no exchange-traded commodities, it's very difficult to access funding in a traditional sense from the debt markets for these sort of projects, which means that, again, like the equity side of the piece, the investable universe for seeking funding for construction of projects, it's much slimmer. The typical lenders aren't normally there because they can't hedge their exposure like they can in the gold markets or other commodity markets. And so you're left with often offtake financing and other people within the industry who are required to step up and fund these projects. And again, we've seen it happen time and time again in the lithium space, and that's now gone a little more mainstream. But graphite and other of these niche commodities, they face the same challenge. There's just not many sources of capital. So one of the biggest risks is that share prices remain depressed, and they are a bit depressed at the moment across the complex. And if they remain depressed, then funding becomes more difficult. And at a stock-specific level, that can lead to some greater uncertainty at the stock level. But at the macro level, when you're looking at the sector in general, that can actually lead to, again, greater price rises over time as the lack of investment leads to lack of supply, which leads to higher prices. So it's all a bit circular, but some of the biggest risks are really just around the funding. And then also there's other areas of risk like resource nationalism. So not so much in Australia, but I guess you could say there are some elements of Australian nationalism and the Foreign Investment Review Board not allowing certain countries to invest in certain assets in Australia. I guess it's at the milder edge in Australia, but places like Africa, where we've seen some pretty high-profile examples of some mines there that tenements have been taken off corporations. They have been nationalised from time to time, and that's a constant risk, particularly as these battery metals are seen as critical minerals. Therefore, countries who have that strong endowment want to make sure that the rent that comes from those deposits accrue back to the people of the country. And so that's another pretty key area of risk that continues to be a focus and will probably lead investors to not invest in certain assets or certain companies with projects in jurisdictions that they perceive as high risk. And the corollary to that is that assets that are located in first world jurisdictions, such as Australia generally, or the US or parts of Europe, will probably trade at a premium because there's no real risk of that nationalisation as you might get in some of these other areas.
Yeah, no, absolutely. And that kind of flows nicely into my next question, which was about, this growing sense of resource nationalism. Do you feel like Australia specifically has enough to kind of fill the full battery value chain? Or are there missing links that, they're partnering with other countries such as South Korea to kind of enable that?
Yeah, it's a really interesting development in I guess in recent years that the government here is keen to onshore a lot of the supply chains, and that's not dissimilar to a lot of countries around the world. And I think the urgency was really brought forward due to the supply chain disruptions we saw during COVID. What Australia is supremely endowed in is the resources. We have great natural resources. We have a pretty robust regime, depending on which state you're operating in, but pretty robust regime to allow companies to progress through the various gates that can allow them to bring a deposit into production. So I'd say at the resource end, the Australian market is very well set up to really build a domestic supply chain. But what we don't have, I think, is a lot of expertise in some of these downstream facilities that's really needed. It's one thing to dig up resources or mine them from underground in a really efficient way, and we're very good at that, Australia. We do it in a really safe environment where we have very few fatalities, if any. So it's very commendable. But taking it to the next level, either refining it and then going the next level to perhaps battery production or even precursor to battery material production, we really don't have any expertise in those areas at the moment. So what's important, and you mentioned it earlier, is to perhaps partner with the people who have those areas of expertise. And look, there's a shot we can do it. It's not a slam dunk, though. I think it would be important to ensure that there's significant time allowed for us to bed down some of these technology transfers and know-how transfers and bring the right partners into the tent. So I think if the governments are supportive enough and they'll create the right taxation regime and government grant regime to embolden people to build facilities here, then I think we've got a good chance at doing it. One issue we do have, though, is we are a long way from the rest of the world. So developing finished products in Australia means that you still have to ship them to far-flung markets. And that's probably another thing going against Australia is, A, we don't have the know-how, and B, we're a long way from anywhere else. But I think if once you've got a finished product, shipping that is often a little bit cheaper than sending the raw material around the world, which happens at the moment. So not to say it can't happen, but I think there's a number of things that need to occur and a number of other linkages that have to happen to other markets to make it really efficient. And it will be good for Australia to be self-sufficient in some of these things, more so than we are today, which creates a lot of uncertainty for some industries and could create opportunities for us to onshore manufacturing in other areas, which I think everyone would agree is a good thing for any country to do. Onshore manufacturing, do more value adding, collect a higher rate of taxation, which can then flow back to the general economy. So, Australia's got a lot of things going for it. It needs to fill a few bits of the jigsaw puzzle, but I think given the government support that's there, it sounds like where there's a will, there's a way.
Yeah, no, absolutely. My final question is really just kind of looking back at the risks to the market. So I wanted to see if you have any opinion on kind of the role of new technologies. So, there's been a growth in, say, hydrogen power, and other green options. Do you find this a risk to the kind of the core battery metals like lithium and copper, or how do you see kind of that all playing out as we move forward?
Yeah, look, I think some of these newer new energy style commodities like hydrogen, for example, look, they're very nascent still. The interesting thing is the governments have been on the front foot quite aggressively in mandating certain carbon, emissions requirements, etc., and have actually mandated that hydrogen should be a part of it, part of the pie. So I think overall it's very positive, and any energy mix should have many facets to it, not just be focused on one thing. So most of the focus in the investment community is on the components that go into a lithium-ion battery, and that's been where the key driver has been. But I think things like hydrogen or even other battery makeups that don't rely on having to go into an electric vehicle where it's all about having low weight and it's all about having a very dense pack. If you have environments where you can have much larger packs because they're out in the middle of, for example, Central Australia, as a battery pack that's helping to power a mine or something like that, you don't have a lot of limitations that you need to achieve within an electric vehicle. So you can use other materials that go into that. So that's where things like hydrogen might make sense, or other types of battery like redox flow batteries or others, where they're not so compact and not so focused on keeping the scale very small and the weight very light. So I don't think that some of these new energies pose specific threats to some parts of our battery metals landscape. I think we need all sorts of different energy inputs as part of the mix. And overall, I think if you're looking at electric vehicles, I think lithium ion is here to stay for the next couple of decades. And the reason I think that is because it takes a long time for the safety levels to be proven and to be engineered into things like a car, which, hurdles down the highway at 100 plus kilometres an hour. You need to make sure that the risk of combustion is low, and that really these batteries are safe in all respects, and that can't change quickly. And also you've had a lot of capital put into not only battery plant manufacturing, but also retooling electric vehicle production lines. And again, they're all built around this new battery pack that's known as lithium ion. So I can't see that changing in the short term, even if a breakthrough came through on a new battery. It's something you need to be aware of. But really, I think the battery metals that we know and love very much on the ASX anyway, being lithium as number one, graphite, some elements of nickel, and high purity alumina. I think these are here to stay, and we shouldn't be concerned about some of these other energy mixes, because I think often those are directed at very different applications than what the EV metals are focused on. Yeah,
no, absolutely. So less so a risk, but more just kind of growing opportunities potentially down the line.
That's right.
All right. So those were all the questions that I had for you today, Julian. So thanks for joining us here today.
Thanks very much, Amy. Nice to talk to you.
Thank you.